Yes, so good morning, and thank you very much for the invitation to participate in this workshop on climate finance. My name is Angela Churie Kallhauge, and I work, as Linda said, at the World Bank, where I head the Carbon Pricing Leadership Coalition Secretariat. So the CPLC is a global multi-stakeholder leadership advocacy initiative that promotes the use of a price on carbon to be able to deliver on ambitious and effective climate action. So I was asked to speak about carbon finance, which to many is synonymous with the carbon market. And from the experience I've had when speaking to many African stakeholders, is reminiscent of the CDM, the Clean Development Mechanism. However, it's important to define carbon finance in the context of putting a price on carbon, as carbon finance is the general term used to refer to resources generated or expected from activities that generate carbon assets. So while climate finance, and I know you've covered all of this in your previous sessions, provides the means of implementation to actions to address climate change, carbon pricing provides the incentive to mobilize mitigation action. And as such, it also can be a source of financing. So among the broad benefits of carbon pricing, and this is one of the reasons why we are promoting carbon pricing as part of the overall climate change action toolbox, is that it does, through the price signal, promote efficient and cost-efficient ways to reduce emissions. It does enhance the use of existing systems and promotes the adoption and diffusion of existing abatement technologies, and thus, of course, shifting towards low carbon infrastructure and investments. In so doing, putting a price on carbon can contribute to driving innovation in technologies and changing business models so as to reduce emissions and promote resource efficiency. Explicit carbon pricing instruments, and I'll speak a little bit more about that, can raise significant revenue, which can be recycled effectively. And I think this is one of the big interests, especially in emerging and developing economies. And they do have larger co-benefits when implemented with other complementary policies that go beyond climate change, which include lowering pollution, congestion levels, contributing to enabling healthier ecosystems, and of course, access to modern energy. So carbon pricing can either be explicit or implicit. Of course, much of the focus when we do talk about it is on the explicit systems, such as a carbon tax or a cap and trade system, including, of course, crediting schemes. There are other implicit policies, and I won't go into those today, but these include mandatory technology standards, removal of fossil fuel subsidies, shadow pricing, all of which together provide the necessary signals that can incentivize mitigation action, of course, in the broader context of system changes and, of course, sustainable development. So I'll provide you first with an overview of carbon pricing around the world. Next slide, please. So each year, the World Bank produces a report called the State and Trends of Carbon Pricing. And the purpose of this report is to take stock of progress around the world on carbon pricing policies and measures. And in our 2021 report, we found that most countries are adopting net zero targets, and we're starting to see more and more ambitious carbon pricing instruments from the EU, through to the Pacific region in New Zealand. So, for example, the EU, the European Union allowance prices hit all-time highs earlier this year as the bloc stepped up the efforts following the announcement of the Green Deal last year. We've also seen increasing price trajectories that have been set in countries like Canada and Germany. And in New Zealand, the Climate Change Act also established a national mitigation framework, including its ETS, its emission trading scheme, in line with the 2050 net zero target. Governments are looking at how they can manage the balance between climate ambition and protecting domestic competitiveness. And many jurisdictions, of course, following the announcement in the EU, are looking into the potential of carbon border adjustment mechanisms. So the range of these instruments all imply that a series of incentives and policy measures that will see a redirecting or an increased investment flow towards mitigation activities is happening and will continue to happen. So next slide. So right now, there are 64 carbon pricing instruments around the world, which is an increase from last year. And of course, keeping in mind that we have been going through a global economic recession due to the pandemic, it's interesting to see that action on climate change has continued. The biggest news in the last year was, of course, China's national ETS, which came online, and this will cover about 40% of its national emissions. That's through the power sector. Germany, which is part of the European ETS, also launched its national ETS, covering sectors that are not covered in the ETS. And the UK carbon market, which replaces its participation in the EU ETS after it left the EU, also started operation. We've also seen national carbon taxes being launched in different countries in Europe, Netherlands, Luxembourg, and starting at around Euro 30. And also seeing initiatives coming up at the subnational level. I think what you will see is that while there is a significant global spread of these initiatives, the extent to which this is happening in Africa still remains limited, with South Africa being the only country with an active carbon tax, Cote d'Ivoire and Senegal in the process of developing similar initiatives. But having said that, and you can go to the next slide, the interest in Africa is not just limited to considering a carbon tax or even exploring a national emissions trading scheme. I will come to some of the other opportunities that we're seeing. In terms of prices in these different initiatives, they range significantly from less than $1 to $137 in Sweden, but only about 4%, less than 4% are covered by a price between $40 to $80. And this range comes from a study that we did a few years ago, where we looked at what level of prices would be needed to deliver on the objectives of the Paris Agreement. And when I say deliver on the objectives of the Paris Agreement, this is both in terms of giving the incentive for emissions reduction, but also to mobilize the investment through these instruments. So we've seen, of course, this wide range of prices. But of course, the different circumstances in each of these different jurisdictions, for example, whether the prices cover the same sectors or whether they have the primary role, are they set to incentivize a change of behavior, or are they set to generate revenue, of course, play a role in the level and of course, the effectiveness. Next slide. So, like I said, while we see very limited coverage of initiatives in the African context with regards to ETS and carbon tax, what we don't see on that map is the degree of interest in the crediting market and the potential that there is to use crediting markets, whether voluntary or eventually under the Paris Agreement, as conduits for investment. What we saw in the last year was that the carbon credit markets have continued to grow despite the economic downturn. And a large share of this occurred in independent crediting mechanisms, where the annual supply numbers still remain far below the level seen at the height of the CDM in 2012. The number of projects and credits issued have increased substantially in 2020. And we know that there was a big expectation that the aviation offsetting mechanism, CORSIA, was supposed to represent a significant amount of demand. And had this materialized, I'm certain we would have seen a lot of engagement in the African context, where many countries had the potential to serve as hosts for these activities. When you do look at the NDCs that countries have put forward, a great number of African countries have indicated a preference to use market-based instruments, either through international markets or they do see the potential to draw on these markets to enable them to meet part of their conditional targets. Next slide, please. So beyond that, what we found is that, as I said at the beginning, the increase in the interest in net zero and the number of targets that countries have put forward has triggered fresh discussions on the role carbon offsetting will play in achieving long-term decarbonization. What we have found is that the scale of effort, of course, to reduce emissions is going to be significant. And while offsetting can contribute to mobilizing finance and lowering the overall mitigation costs, there's, of course, a significant debate going on around the environmental integrity, the implications of the trade-offs with other sustainable development issues. But a lot of work is going on, not least within the CPLC, where we are working on a report right now on the role of carbon pricing in achieving net zero, but also through different initiatives such as the Task Force for Scaling the Voluntary Market, the Voluntary Market Credibility Initiative, Science-Based Targets, a range of initiatives that are looking at guidance on how to unlock the full potential of crediting schemes, whether domestic or international, whether voluntary or within a compliance scheme, to enable the level of activity, and in this context, the level of investment that will be commensurate to what is needed to deliver on Paris. So carbon credits, I think the bottom line in all of this is that they should represent real additional verifiable and permanent emission reductions. And the integrity of a credit rests on meeting a range of criteria and, of course, requiring the appropriate systems within the countries to ensure that there are significant safeguards to make sure that these investments do happen and do deliver. Next. So when talking about carbon pricing, I mean, I focused very much on the jurisdictional level, where public authorities have the lead, but there is significant use of carbon pricing within the context of the private sector. And this, of course, has an implication for not only the rate of return of their investments, but also is providing a good incentive to mobilize resources to advance operations across different sectors. So what we have seen is that nearly half of the largest 500 companies, the Fortune 500 companies, use or are intending to use an internal carbon price within the next 2 years. I think the statistics that I had seen, for example, for South Africa, was that 50% of their top 100 companies were using a carbon price in some form or the other. And many in the energy and financial sector are the ones who have seen the greatest increase in the recent years. Now, a carbon price in the context of a company is normally linked to the company's financial performance and is a tool to enable them to embed sustainability into the context of their profitability. Many use this as a metric to assess the financial risk of investments. In some cases, some companies, for example, like Microsoft, have set an internal carbon fee that enables them to shift investments from more polluting activities to more efficient activities, therefore having an internal generation, a system of generating revenue to sustain their sustainability targets. Putting a price on carbon in a company context also helps them manage their climate risk and exposure. Quite often, this is set at a level to preempt what the regulatory prices would be, and as such, prepare them for upcoming regulations, helps them identify opportunities for smart investments, and of course, to transition to low carbon alternatives. It's also a very important tool to communicate to stakeholders or to the shareholders and quantify the cost of project emissions. So 2020, just under 1,000 companies disclosed that they were using an internal price. And this is about a 20% increase in 2019, which is significant. So carbon pricing and climate finance, as I said, so looking at what carbon finance is in this context, you cannot separate it from the incentive structure that is created by putting the price. Just last year, in 2020, what we found was that the carbon pricing instruments around the world generated about $53 billion in revenue globally. And that's an increase of about 8 billion, and of course, a significant increase given what the world was going through. But this was largely due to the increase in the EU allowance price due to the now long-term policy certainty that the new Green Deal has given. Now, carbon revenues are being used for multiple purposes around the world. In some countries such as Sweden and South Africa, the revenues are sent directly to the general government budget, where climate priorities are mainstreamed, while other countries do have some degree of earmarking for specific uses. So for example, when we look at initiatives such as in California, much of the revenues from the California cap and trade has been used for social projects such as affordable housing, renewable energy and public transportation. And at least 35% have gone to disadvantaged communities and low-income households. Again, an important consideration given that the introduction of policies such as a price on carbon, whether it's through taxation, can have an impact on low-income communities, and therefore to enable an inclusive process, rebates to disadvantaged communities is critical. In Canada, in 2019, there was significant discussion around the federal backstop, where much of the dividends from the carbon pricing initiatives were distributed as what they call climate action incentive payments, and will be provided annually to tax-paying households. And I guess this is also to give them an incentive to look at opportunities to invest these monies towards better climate action, either within the households or in their communities. And similarly, British Columbia has provided tax credits to offset carbon taxes for low and moderate income folks, and to reduce the income and corporate taxes. So around the world, we've seen different uses. I think Chile was using their revenues towards education, among other things. Again, a critical element when thinking about the social transition towards a low carbon or a net zero future. So as such, carbon pricing through the different instruments, whether taxation or trading or credits, can generate significant income. And that is, of course, the link towards climate finance, not only in incentive, but also in the monies that come through. So I'll just conclude with a couple of words on looking ahead. I think as we head towards COP26, there's going to be significant discussion around what the Article 6 market is going to look like, the guardrails for that market, especially in the context of the increasing number of net zero commitments and targets that we're seeing both from governments and corporates. In this context, I think there is a recognition that the use of pricing instruments, whether it is taxation, which seems to be favored quite often in developing countries because of the administrative simplicity, or whether it's the use of crediting schemes, will require significant work to enable the full integrity on the use of this, but also to ensure that they do contribute in a transparent and accountable way to addressing climate change, as well as to contributing to sustainable development. So I'll stop there. Thank you for your attention.